The system has been lying to you about money for years. They tell you just save money, be responsible, put it in the bank. One day you'll be rich. But in 2026, that advice is quietly keeping millions of people poor. You do the right thing. You save every month, $100 here, $200 there. You feel disciplined. You feel safe. Then you open your banking app one day and see your savings account has $10,000, earning a pathetic 0.5% interest. After an entire year, you made only $50. Meanwhile, the rich are getting richer through investing, compound growth, assets, real wealth. This is not your fault. This is by design. Saving protects your money. Investing grows your money. And most people never make the transition. They stay stuck in saving mode for decades while inflation quietly eats their future. Today, I'm going to show you the exact step-by-step path to turn your savings into real investing without feeling overwhelmed and without risking everything. This is LLEBA versus the system. Let's expose the trap. Picture this. You finally start saving seriously. Every month you move money aside, you feel mature, responsible. But one day reality hits. Your savings are barely growing. Inflation is higher than the interest rate. Your money is actually losing value over time. That's when the big realization comes. Saving alone will almost never make you wealthy. It gives you security, but it rarely gives you freedom. The brutal math proves it. If you put $10,000 in a normal savings account at 1%, after 20 years you'll have around $12,200. Now invest that same $10,000 at a conservative 8 to 10% average market return, like index funds. After 20 years, you could have over $45,000 to $67,000. Same starting amount, completely different life. The difference isn't intelligence, it's understanding when and how to move from saving to investing. Here's the exact path smart people follow. Step 1. Build a real emergency fund first. Before you invest a single dollar, you need 3 to 6 months of living expenses in cash. This is your safety net. Job loss, car breakdown, medical emergency, life happens. Without this, you will panic sell your investments at the worst possible time. The emergency fund protects your investments from your own life. Step 2. Create the two-bucket system. Stop mixing everything in one account. Bucket 1, safety money, emergency fund plus short-term needs, stays in high-yield savings. Bucket 2, growth money. This is what you invest. This mental separation reduces anxiety dramatically. Safety money doesn't fluctuate. Growth money is allowed to grow over time. Step 3. Start small and build the habit. You don't need thousands to begin. Many platforms let you start with $50 or $100 per month. The goal at the beginning is not massive returns. The goal is building the habit of investing consistently. Step 4. Choose simple, proven investments. Forget day trading, crypto speculation, and complicated strategies when you're starting. Start with low-cost index funds that track the overall market. They are diversified, historically strong, and recommended by legends like Warren Buffett for normal people. Step 5. Stay disciplined through volatility.
Markets will go down. Headlines will scream bloody murder. Your account balance will drop 20%, 30%, sometimes even 40% in a matter of weeks. This is not a bug. This is normal. And this is exactly where 95% of people fail. When the market crashes, the system wants you to panic. They want you to sell everything, lock in your losses, and run back to the safety of your savings account. That's how they keep the wealth transfer going, from the patient to the impatient. Smart investors, the ones who actually build freedom, do the opposite. They buy more when prices are low. They understand that market crashes are not disasters, they are sales. They are the greatest wealth transfer events in history for those who are prepared. Let me give you a revelation most finance gurus will never say out loud. Volatility is not risk. Time is risk. If you have 15, 20, or 30 years ahead of you, short-term drops are not dangerous. They are opportunities. The real risk is keeping your money in cash for decades while inflation silently destroys its purchasing power. Look at history. Every single major market crash in the last 100 years has eventually been recovered from and gone much higher. The people who made life-changing money were not the ones who timed the bottom perfectly. They were the ones who stayed invested and kept buying through the fear. Compounding is the most powerful force in the universe, according to Einstein. Yet it feels incredibly boring in the beginning. That's by design. The system doesn't want you to understand its true power. Let's run the real numbers so it hits you. If you invest $500 per month at a realistic 8% average annual return, which is conservative for a diversified index fund portfolio, after 10 years, roughly $91,000. After 20 years, roughly $295,000. After 30 years, roughly $755,000. After 40 years, $1.8 million. Now compare that to just saving the same $500 per month in a traditional savings account at 2%. After 40 years, only $330,000. Same monthly sacrifice, completely different life. That gap of over $1.47 million is not luck. It's the difference between understanding compounding and ignoring it. But here's a deeper revelation. Most people never reach the powerful part of compounding because they quit during the boring middle years. The first 7 to 10 years feel like nothing is happening. Your balance grows slowly. The market has ups and downs. Life throws emergencies at you, and suddenly you think, this doesn't work, and you stop. The people who become truly wealthy are the ones who survive the boring phase. They treat investing like breathing, automatic, consistent, and non-negotiable. Another uncomfortable truth: saving money gives you security. Investing money gives you freedom. Security feels safe. Freedom feels scary at first because it requires responsibility. You have to learn. You have to tolerate volatility. You have to think long-term in a world that rewards short-term thinking. The system profits massively when you stay in saving mode. Banks love your money sitting in low-interest accounts. They lend it out at 8 to 20% while you pay 1 to 4%. That spread is how they build skyscrapers while you fight for rent.
This is the modern financial matrix. They don't need to steal your money directly. They just keep you in financial tools that benefit them and stagnate you. Here's something even deeper. The psychological shift from saver to investor is one of the most important identity changes you will ever make. A saver thinks in scarcity. I need to protect what I have. An investor thinks in abundance. How can I make my money work harder than I do? This mindset shift changes how you make every financial decision. You start asking better questions. You value time more. You become less emotional about market fluctuations. You start seeing opportunities where others see chaos. Real story. I know a man who started investing seriously at 33 years old with only $400 per month. He had a normal job, normal salary. During the 2020 crash, while everyone was panicking and selling, he increased his contributions. By 2026, at age 42, his portfolio crossed $480,000. He didn't have a six-figure salary. He didn't inherit money. He simply made the transition from saver to investor and stayed consistent. That is the power available to you. The biggest wealth gap in 2026 is not between those who earn a lot and those who earn little. It's between those who only save and those who learn to invest. Saving is defensive. Investing is offensive. Saving protects you from poverty. Investing gives you a real shot at prosperity. If this video is hitting you hard right now, that's good. It means you're ready for the next level. The transition doesn't have to be complicated or risky. You start small. You educate yourself. You automate everything. You stay consistent even when it's boring, especially when it's boring. Because the boring phase is where real wealth is built. You've been warned. Saving is the first step, and it's important. But investing is the real game. The game the rich have been playing quietly for generations while telling everyone else to just save more. Now the choice is yours. Will you stay in the safe but limited world of saving only? Or will you step into the uncomfortable but liberating world of investing and compounding? If you choose the second path, comment "I'm transitioning" below right now. Like this video if you want more people to wake up from the saving trap. Subscribe to LLEBA versus the system and turn on notifications because we don't give you comfortable lies. We expose how the financial system really works and give you the practical weapons to beat it. In the next video, we're going much deeper. The best beginner investments for normal people in 2026, no BS guide. Saving is the foundation. Investing is how you build the house. This is LLEBA versus the system. Stay dangerous with your money and patient with your capital.